Thank you for joining me. I'm Alex, and I want to talk about a company that I don't think should exist, and that is H&R Block. So what they do is mostly tax returns. They also, I believe, have a software that allows you to do things easier, basically. Current price $16.16, which gives them market cap of just under $3 billion. Dividend yield is 6.44% with a payout ratio of 104%, which actually is not really true for the past year, but it's things are sometimes calculated trailing 12 months instead of the last fiscal year, so that's where this comes from. Revenue $2.6 billion, which is down significantly. Earnings negative $7.5 million, which is also down, over 100%. And their current PE is 16, which again is not based on the last fiscal year, obviously. Forward PE of 6, which would be pretty amazing if they got there. I'm not entirely sure if they will, though. Total assets, $4.1 billion. Total liabilities, $5 billion, which gives them a total stockholders' equity of $71 million, which is also down significantly, shockingly enough. So as far as the risk factors go, I think the main one would be that the reason I don't believe this company should exist is that they actively lobby against making tax returns simpler, and if Congress actually stopped, taking bribes and passed the laws that have been basically on the ballot for decades, everyone could just get their tax return in the mail, sign it, and send it back, and be done with taxes in about 2 minutes. So the major risk factor is just legislative change making them obsolete. I don't really see that happening, especially not this year, so not sure what else is there. Obviously, there's many other companies trying to do the same thing, so I don't think anything changed recently that changed the risk factors. So overall, obviously hate the balance sheet. Negative earnings, always a bad thing. 104% payout ratio, also kind of a bad thing. But overall, for a growth investor, obviously negative growth of 20-ish percent, 15-ish percent, not great. For a dividend investor, the dividend is amazing, obviously, but payout ratio of 104% is unsustainable. But if they actually do get to a PE of 6, that means the payout ratio will go down to 40-ish percent, which is obviously quite sustainable. The balance sheet obviously still a problem, so I'm not sure if I would risk it. You might lose a lot of money if they cut the dividend and ultimately the stock price goes down. So definitely not a safe investment here. For a value investor, the balance sheet is just total crap. The negative earnings, always a problem. If they can hit the forward PE of 6, obviously that would be rectified. But overall, I'm not sure if I can look past the balance sheet and in good conscience recommend this stock, which may very well lose a lot of value if they do cut the dividend, which they probably should. If they can hit the forward PE, they're probably pretty safe, but the safety of the company should obviously not be understated. So overall, I wouldn't recommend the stock despite the stats, most of them actually looking pretty decent. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.